it's going to be a really tough, sticky time for the US consumer probably over the next 18 months. And so I tend to think that, through the course of this year and through 2023 and possibly even a little bit of 24, it's going to be a grind. Unemployment will go back up. Inflation will be sticky. Real earnings will shrink. Consumption will ebb, and earnings will not be that great. But the silver lining is I think that we are starting a bottoming process for the equity markets. And I think that by the end of this year or the early part of next year, most of that will be done. And the reason is that, the equity markets, I think, do a reasonable job of, one, looking at the bond market, and then two, looking 6 to 9 months into the future and pricing in that future today. And so by the end of this year, beginning of next year, I think that we will have kind of bottomed and we'll start to build a base. The thing to remind us, though, is that, let's just say a stock goes down 50%. Even if it rallies 50% from there, it's still 25%
but I think
off.
That people don't understand that.
People don't understand that.
Climb back up the mountain.
So I would just think, tell people that, I think that David is right. I think that it's we're going to feel this for a while. This inflation, as I've said for a long time, is going to be sticky and persistent. I think you're going to see Fed funds at or breaching 5%. And but I think that in terms of risk assets will bottom out by the end of this year, beginning of next year.
I mean, Larry Summers had some good tweets this week. It's so ironic and sad to watch because he's such a thoughtful economist and has such a great point of view and experience to leverage here. And clearly, he was banging the drums last year and no one was listening, and then he got public about it, and now he's more repeatedly public about things. The point that he's made, which I think plays into the political cycle question, which is where the tension arises, is in order to resolve ultimately the inflation problem, you're going to have to see a significant increment in unemployment. And so when you raise interest rates, generally purchasing goes down, demand goes down, revenue goes down, layoffs happen. Some businesses go bankrupt, etc. So then there's this trickle in the economy of less people being employed. And when that happens, it ultimately drives a political response, which is, hey, we're losing our jobs. People start asking their representatives, do something about this in Congress. And then these programs and these things get passed, which themselves are inflationary. And that's why it's very hard to predict ultimately when and how this all gets resolved, because we seem to have an administration that is enacting and embracing inflationary policies to support what they consider to be economic growth and improved employment conditions in this country. And the unfortunate effect of many of those policies is inflation. And then it forces this difficult central bank decision-making cycle. And so there's a tension right now that doesn't seem to have a clear path to resolution. That is why it's very hard to have a clear prediction here. We also have a very significant question overhanging all of these markets related to the price of energy, which is a key input to so many industries and drives cost, as well as food, and also the military conflict in Eastern Europe. And and then there's in the financial markets this big overhang question on what's going to happen with various countries that may default on their debt, as well as China's real estate bubble bursting.
I mean, we're kind of ignoring what happened this week, where Putin basically is putting nukes back on the table. Now, I'm not saying that's likely to happen, but I don't know how this market gets a lot better with the risk of World War III hanging over our heads.
Well, they unfortunately don't have access to it, really. They have empirical sampling, but to say that the U.S. economy is automated in a way where they can sit in front of some dashboard and see in real time what the true on the ground data is not really accurate, unfortunately. Maybe there's a Manhattan Project type effort to do that at some point for the United States, but it's not now.
Right now, U.S. venture capitalists are sitting on $290 billion in dry powder. We had talked about this last year, how much dry powder was there. The market has obviously collapsed. But here's a chart from our friends over at PitchBook. Just extraordinary how much has built up and how much has been raised. US VC funds raised $121 billion during the first half of this year, 2022. So LPs still have an appetite, which kind of makes sense. Investing into the down market for private companies means you're going to get better deals, and you have a 10-year horizon. US VCs raised $139 billion in all of 2021. So if you put those two numbers together, yeah, you're looking at $260 billion in the last 18 months. And this is all record numbers being put up on the board. What does this say for private companies, Zach?
I think there's a couple of things going on that need to be taken into consideration. First of all, new funds don't get announced till after the process completes. And then, it may even be some time after that when the VC firm feels like they want to make the announcement. You can't announce a fund until the process is completely over, or you get subject to all sorts of additional SEC rules. So, these funds might be announced in 2022, but they may have actually been raised in 2021. So that, I think, is a really important point. Moreover, a lot of the funds may have already deployed capital before the crash. So there was that, I think, remarkable story that we talked about months ago in TechCrunch on how the latest Tiger Fund, which wasn't even announced till March or April of 2022, but it had already been 2/3 deployed by the time they even announced it. And so that was pretty stunning. So I think that we don't really have a great sense of how much of this so-called dry powder has already been deployed, how much of it was really raised before the crash. It is true that LP relationships with VC firms that have done well are sticky, and good LPs stick with their partners during a downturn. So look, the VC world's not going out of business or anything like that, but I would tend to think that this is an overly optimistic, overly rosy scenario. Do VCs have new funds that they're going to be ready to deploy in great companies? Yes, but does this mean it's going to be easy? No, I think that the bar has gone up, valuations have gone down. Founders looking at this tweet storm, I would not get lulled into a false sense of security.
Yeah, I agree with that.
Just to explain that, there's probably a 6-month lag on when these funds are announced. The reason is there's 506B and C designations. Most people raise under 506B, which means you cannot even say that you're fundraising. Therefore, PitchBook can never have that data. So there's a lag, and people were deploying at a very high velocity. Therefore, this number could be off 35%.
Well, if people were deploying at a pace where they thought they were going to go back for a new fund every year, which is what it was looking like in 2020 and 2021, if that 6-month period might mean you've deployed half the fund.
Right.
So, but look, if you just go back to a 2.5 or 3-year pace of deployment, and before in 2021, we're at a 1-year pace of deployment, divide the availability of capital by 2/3. Only 1/3 as much will be deployed in any given year. That's a significant reduction. So I think founders should just be aware that the market's going to be a lot tighter. And I think given what we're seeing in the public markets this week, it doesn't look to me like it's going to get any better. It looks to me like we're headed for, I called it a double dip recession, I think a couple of months ago. That's exactly what it's looking like. In fact, the Fed basically said as much. The Fed said that would be just marginally positive next quarter, so it would bounce back to slightly positive growth on a real basis, but then expect it to go negative again and recession once all these interest rates kick in. And by the way, kudos to Chamath for basically calling that, when the Fed just a couple months ago was saying that so-called neutral would be 3 to 3.5%, Chamath was saying, no, it's going to be 4.5%, 5% plus. Now the Fed just in 2 months has revised to saying that neutral is 4.6% or something like that. And they don't think there's going to be any rate reductions in 2023. So this is not looking good.
What is happening here?
There's the short term and the long term. I think what's happening in the short term is that the same thing that we are talking about in the United States that Sachs is, very eloquently basically I think led most everybody in just really framing for a lot of people is this idea that, we have privatized free speech and we have put the distribution of information into the hands of 3 or 4 founder CEO oligarchs. That's also true in China. And when you look under the hood of the major internet companies, there's 4 or 5 guys that are in charge. And so I think that in the United States, politicians feel increasingly uneasy with those folks having power because it's applied indiscriminately. Trump gets banned, Trump may not get banned, this person gets distribution, this article is considered misinformation, that article is considered disinformation, this article is suppressed. It's a dangerous place to be. And in China, they were just like, enough's enough. So I think the short term, as it relates to the internet companies, was basically a realization that we are not going to allow any more devolution of power from the Chinese Communist Party to and into the hands of these internet entrepreneurs. So that was sort of like the...
So it's a move out of fear. They're scared they're going to lose their power base.
Not scared. I think they're just smart, and they were like, we're not going to allow this to happen. So they don't have to deal with Section 230 or any law like that. I think it was just a realization that we want them to understand who is boss, right? And so there was a wave of resignations. There was now all of this market cap upheaval. And this is now where we get to sort of like the appetizer. And I think in the appetizer, what they're basically saying is, we will control how money is made and who makes money. And I think that sets up the really difficult thing that I think happens, which is about the long term. So in this thing, what's happening right now is China very firmly telling everybody, we are firmly in control. There is no private market and there is no capital market without our approval. And that's a really big statement. And in fact, it was such a big statement that I think the Chinese security authorities then had like a conference call on Goldman Sachs, JP Morgan, all these folks were invited. And, the vice chairman, basically, his quote was something to the effect of, we promise that any more changes will at least let you know. Not, hey, there's nothing to see here, or there's nothing more to come. It's just more that as we decide new rules, we'll make sure that we give you guys enough warning.
That's it, guys, from here today. Thank you so much for watching. Please hit the like button and do subscribe if you haven't already. Thank you so much for watching, guys. I hope you all have a good day.